Cam Brower for Cam's Mortgagement. One of the things I hear often from folks is how the house prices have outpaced wages. And I read across an interesting stat the other day, which helped kind of shed some light on it. And basically it said that back in 1997, the average house price in Canada was $154,620, which resulted in about 4.9 times the average pre-tax annual income of an individual with a full-time job. And at that time, the average income was $31,484. Flash forward to the end of July of this year, and we have an average house price of $379,725, which puts houses at about 7.8 times income of an annual amount of $48,497. So this is classic proof that definitely house prices are outpacing the rise in wages. If you look at it, allowing for inflation, most people expect it to keep up as far as wages go to around the 2% mark. However, house prices have been going up by about 5.4, so they've been going at a double the pace. How long can this sustain? You know what? At some point, there's going to be a wide disconnect between this. Now, what has allowed this to happen? Well, some of the folks are pointing to the fact that we've had 30, 35, 40-year mortgages. They've allowed folks to stretch out those payments, make them lower, so the qualification fits better. A lot of folks would say that these low interest rates, which was a result of the financial crisis in 2008, and since then rates really haven't risen much, all they've done is drop. They have fooled us into a false sense of security and basically driven our residential house prices through the roof, so to speak. Again, like I said, all good points, and for the consumer and for the savvy consumer who's taken advantage of these savings, I was calculated that on an average $400,000 mortgage, these rates have probably resulted in savings of about $400 per month. So if one was smart enough, took advantage of it, and looked at paying down debt and taking advantage of these low rates, they were a winner. Now, where do rates forecast for the future? Well, there's mixed reviews. If you look at some of the news that's coming out of Canada, it would be that rates aren't going to change much. However, the Organization for Economic Cooperation and Development said last week, an international think tank, that Canada is going to have to raise their rates, and they're saying that by 2015, they may have to even more than double the central benchmark rate. Again, those would be pretty big numbers and a pretty big change overall. But we know that these low rates definitely have an effect on the market. Now, some would argue it's unhealthy and it's unsustainable. Well, at a rate of double for house values versus wages, I would definitely have to concur. At some point, something has to give. Now, the one thing that you do have to bear in mind, especially in the market we're living in Victoria, we have rental incomes. A lot of folks that have these disparities also have rental incomes that offset these, stark differences. So in this report, I didn't see that factored in there because that income is definitely helping alleviate some of those pressures. For the folks that don't have that rental income, definitely a strain. And I know that in other parts of the country where house prices are a lot more affordable relative to income, there's definitely some different numbers. So what does this mean for the future? Well, it means that we'll have to see where all of this is ramping up to, what's going to happen in the key markets like Toronto, Vancouver, and the major centers. But bottom line to me, it's pointing at the same thing as it always does, and I repeat to you time and time again, these low rates are a time to take advantage of paying down debt, especially under shortening your amortization if you have an existing one, focusing on other types of debt, restructuring. We talked about that last week. This is a wonderful time to be looking at all those sorts of things because let's face it, we would all love to get raises of 5.6% annually, but we know it's not going to happen. And we better make sure that we've got a plan for what happens when these wages, like I said, these wages don't keep up and rates do go up at some point. Anything you need mortgage-wise, don't hesitate. Call us at the Auxilium team. Auxilium, as I always tell you, means simply to care, aid, assist, and support. And that's what we do here day in and day out. And we look forward to assisting you. At the end of the video, please make sure, if you're not a subscriber, subscribe to our YouTube channel. Like us on Facebook, check us out on Twitter, and we look forward to connecting with you whenever you're ready.